A new report says growth in Canada's clean technology industry is stalling. It was published by Analytica Advisors. It's an Ottawa-based company monitoring the expanding clean tech sector. It says without increased investment, Canada could miss its opportunity to become a global heavyweight in the industry. For more on the report, we're off to Ottawa to speak to the president of Analytica Advisors. Salam Beck joins us now. Good to have you with us.
Thanks for having me with you.
Access to capital seems to be the biggest concern you're hearing here. What of the $1.8 billion that the building behind you earmarked in the last budget?
Well, that's a significant amount of money, and public dollars are scarce dollars, and they need to be husbanded carefully. The budget anticipates that money will flow in 2018, 2019, and the opportunity for the industry is now. It's in the next weeks. We have companies who are beating the competition internationally, ready to deploy, and who need to have access to that capital in weeks, not months, so that they can fulfill their order book and they can keep more Canadians employed and get real value and prosperity as a result of the deep intellectual property they've built, like your previous guests that are working in electric cars and in self-driving vehicles. We've got some really important intellectual property in Canada that we need to get some value for.
Help me understand the mindset of the potential investor, because we know that while revenue is up for clean tech, broadly speaking, most of these companies still are not profitable. Yet you look at a Tesla Motors, it's not profitable, its stock's through the roof. You look at companies elsewhere like Amazon, it's not profitable largely, yet its stock is through the roof. How do we square that circle?
Well, obviously, these are companies that have a great deal of market potential. So the global clean technology market is now at $1.15 trillion. It's partly based on drive for a change in the energy sector. It's also driven by energy efficiency, by new laws and regulations in terms of the chemicals industry, circular economy. There are many drivers that are helping that market grow. It's growing at 4% compound annual growth rate, so it's a healthy growth rate, same in fact as the automotive industry. So the market is very large and the potential is very significant, and that's obvious in the stock price of companies like Tesla. We have some Canadian firms that are building on that. Enerstore is an example, and they're actually the sole distributor of the Tesla Powerwall, and so they're still a private firm, but there's a market there that is going to help that firm grow. But how do banks lend to companies that are not yet profitable and that have taken their assets and really put them squarely behind their IP and their know-how? And that's a challenge, and so I think that's the opportunity that we need to address on Bay Street.
And I guess the risk as well is that if we're not sufficiently funding these companies that have great intellectual property, at some point they go bust, somebody else comes in, snaps up the IP at a discount, and now Canada doesn't own that intellectual property. Someone in China or the United States or elsewhere does.
Absolutely, and it's something that Canadians, I think, are really, they expect us to be prudent with the great investments that we've made in both the private and the public sector in know-how and in patents. And if we track Canada's market share in terms of clean tech global exports, it's declined from 2% to 1.3% in the last 7 years. Similarly, our share of patent applications has also declined, and it's pretty well at the same level, 1.3% globally, whereas it was just a few short years ago at 1.6% of global share for patent applications. And China is coming on really strong. There's a political imperative in China to really invest in this type of innovation. And so our firms, are operating in China. They're known to Chinese investors, and it's a global market for capital. So we need to be engaged and understand what's going on.
So in addition to the $1.8 billion earmarked for clean tech by Ottawa, how do we get that cash injection into the industry?
Well, you know, chief risk officers of Canadian banks have obviously looked carefully at some of the risks that the housing industry was posing to their lending portfolio, and they've acted on that. And you probably are aware, Mark Carney and Michael Bloomberg have been working for about 1.5 years now on trying to understand the risks that climate change pose to investment portfolios, lending portfolios for the largest pension funds in the world and for the largest banks. And so as that work is translated into the Canadian banking industry, the Canadian asset management and asset ownership sector, we're going to see greater care and consideration of what climate risks are currently embedded in those portfolios, and that will be part of developing the debt markets and the investment markets for low carbon solutions. It can take a little time to have all of that translate through underwriting requirements and investment theses, but it's going to really open up capital markets. The thing is that in the short term, we need to be really focused on making sure that those companies have the cash they need to manufacture what's needed for the order book that they have. And as their success in making sales increases their working capital requirements, then we need to make sure those are addressed. Otherwise, the companies will look elsewhere.
Celine, we appreciate your time. Thank you so much.
It's a pleasure to be here, Michael. Thanks for the opportunity.
Celine Back is the president of Analytica Advisors. She joined us from Ottawa.